Hey everybody, welcome to Stock Talk. This is a little video slash podcast that I like to put together about once a week, where I like to talk about all things investing, where I share some of my insights, my observations, what's going on in the stock market, and also some of my thought processes that go into some of the investment decisions that I make. Sharing that information with you just so you can maybe take some of it back with you and kind of use it and frame it into some of the investment decisions that you're facing. So my name is Amin Reina, and I'm an investment coach and founder of Sage Investors. And as an investment coach, what I do is I help new and existing investors who want to become more financially independent but just feel kind of intimidated, confused, scared of the whole investing concept. They either don't know where to start as it pertains to investing, or if they've been investing for a long time, they're just not seeing their portfolios get any traction. So what I do as an investment coach is I teach people, I engage with them on how to make more educated investment decisions so that they can ultimately achieve a certain level of financial freedom in their lives and achieve it with confidence. So this is episode 83, and as we're kind of halfway through the year now, I thought it would be a really good time for me and for us to take a look at how my Robo Advisor portfolio has been doing, kind of at the mid-year mark. So I thought I'd just weigh in and give everybody an update on it. For those of you who are just jumping on to the podcast or have just aren't aware, just to get everybody up to speed. What I'd been doing about 2.5 years ago, I opened up an account with a Robo Advisor service here in Canada. And at the time, the Robo Advisor this whole Robo Advisor technology / investing, online wealth management was just just getting out there and has been creating quite a lot of buzz in the industry, from the fact that this model, a lot of people thinking this type of approach to investing is going to disrupt the whole traditional aspects of investing, how we work with a broker or a portfolio manager or a financial planner to build our portfolio to invest. And a lot of people thinking this kind of model is going to threaten that traditional way of how we invest. But one of the things I always wondered about is, can a robo-advisor service or this type of methodology, this approach to investing, how does it do in terms of performance? Does it do as good or a better job of generating meaningful returns for investors than the traditional ways of how we invest? And the problem was, a lot of these robo-advisors, because they're so new, there wasn't really much of a track record, and a lot of times whenever I try to interact with some of these companies and ask these questions, they just don't even go there. So I thought I'd just do a little experiment and say, what if I put some money in one of these things and just kind of follow the experience, go through the experience of working with a robo-advisor service and tracking and seeing what happens when you put your money in this type of service, and kind of report in and come up with some unique insights that I thought all kinds of people should be aware of. So what I did was, about 2.5 years ago, I just took $5,000 of my own money and I opened up an account with a Robo Advisor service. And so if you go to my website, sageinvestors.ca, you can find all my posts. And essentially what I've been doing is just blogging about my experience usually at the half year, on an annual basis, what's been going on with the portfolio and unique things that I've been seeing with the whole experience. So if you go to my website, sageinvestors.ca, you can see all my blog posts related to it and also the podcast too. So as I said, we're in the mid-year mark right now, so I thought I'd just weigh in, check in on the portfolio, see what's been going on with it, and share with you some insights. And guess what? There's quite a few insights I'd like to share with you. Actually, the thing is, if you listen to one of my earlier podcasts during the year, this was just shortly after I did my 1 year, or my annual review of my portfolio. I did another kind of a special episode where I chimed in on some changes that happened at the time with the portfolio, in terms of how the portfolio was structured and some of the asset allocation changes, because there were some significant moves that were made. And at the time, I was kind of giving the Robo Advisor the benefit of the doubt. I thought maybe they're just kind of doing some tinkering and just doing some adjustments. They're just kind of rejigging some things for something bigger that would be a little bit more of a long-term thing. And so I said, you know what, I'll just hold off, and then I would come back in the summer and check it in again and see if those changes really did stick, because then we're dealing with a totally different dynamic, or if it's gone to some other step. So basically what's happened is, since I reported last earlier in the year, those changes that I reported earlier in the year, they've stuck. And there really hasn't been any material, that next step that I was anticipating or expecting maybe. No, it's there. What the Robo did in February is pretty much the way it is right now. So let's just go through some of the numbers, and let's go through some of the asset allocation, and then I'll just chime in with some of my comments and observations. So when we look at kind of the mid-year performance, some numbers here for you. So year to date, my Robo portfolio is up about 5.5%. And if you go back to inception, the time I opened up the account in 2015, in January 2015, the portfolio is up about 14%, so 14.2%. This year, the portfolio has so far generated it's up about $300 if you're looking from a dollar perspective. 53 of those dollars has been in the form of dividends. So that kind of gives you a bit of the ratio of capital growth and dividend growth on it. Most of the returns that have been generated so far this year have really come from the US component and the foreign equity component, which is foreign equities and emerging market. So overall, the portfolio is making money. It's generating returns, which is great. That's really why we do this stuff, right? Why we want to see. We want to see positive. We're going in the right direction. We're not going backwards. We're going in the right direction. 5.5% return year to date, that's decent. Again, my expectations is I'm not looking for my portfolio here to outperform the market and beat the market every year. I'm looking for it to generate, a reasonable rate of return. And given the fact that my portfolio is structured basically 85% equities and 15% income or bonds, realistically, when you look at long-term performance of stocks, if you're in kind of the 6 to 8% range on a typical year, that's a pretty good year. That's a pretty decent year. So, 5.5%, it's kind of good. And, halfway mark, again, a lot of things could happen. Things could crap out and we could be in the negative. But right now, so far so good. It's, it's there type thing. Now, the big change really is, as I said, really has to do with the asset allocation. And, it's interesting, when I opened this account, there was like a lot. One of the things I was surprised was how segregated or segmented the asset allocations were. There was all kinds of different types of asset allocations that I wouldn't think would be in that kind of portfolio, but were there, and so that was a bit puzzling. But what's been happening, it seems like over the last 2.5 years, is it's kind of the Robo is kind of making a conscious decision to kind of streamline things and go to really a very passive-oriented portfolio. So what's happened since in the last while, and so far this year, is we've seen the Robo has, and I call it Robo, instead of Robo Advisor, I'm calling it Robo, short form, is what they've done is they've sold off a few components. Previously, there was an allocation towards dividend stocks, and that was held by the Purpose Funds ETF. And so the Robo has sold that position, so it's out of there. There was also a real estate allocation, real estate investment trust allocation, and that was again held by, there was a Purpose real estate ETF allocated to it, invested in it. And so the Robo sold that one off too. So what it's done is it's taken those proceeds of getting out of those sectors and it's reallocated them to sort of the rest of the portfolio. More specifically, it's reallocated them to the Canadian equity component and it's reallocated to the US equity component. And it's quite significant what's happened. For the Canadian equity component, when I opened the account, 10% of my portfolio was in Canadian equities. Now, it is 22.5%. So it's literally more than doubled. The weighting is more than doubled in the last couple of years. The US component, when I opened the account, was at 15%. And last year it went up to 20%. And now, as of right now, it's at 32.5%. So right now, So that's double the position, double the weighting, more than double the weighting. A third of the money almost of my portfolio is in US equities. So now we're in a situation right now that almost like basically 55% of my portfolio is now made up of Canadian and US stocks. And that's quite surprising that we have so much of that. Like so much of the portfolio is now allocated to that. And it's interesting now because the portfolio also has a foreign equity and emerging market equity component. And those weightings have essentially remained stable or similar, or they've actually fallen a little bit by a couple of percentage points. So what's happening here is now my portfolio now has clearly skewed heavily now into North American stocks. And the question is why? Like, where did this all of a sudden come from? We went from a very diversified portfolio, which was one of the value propositions of the whole Robo Advisor service, is that they put their money across a variety of different sectors using broad-based kind of ETFs. But now they've gone very concentrated. Now, literally, more than half my portfolio is now in North American and equity stocks. And that's kind of not, from a diversification perspective, not that, really doesn't follow those kind of principles. And also what jumps out at me is just the fact that it's so concentrated in North American stocks. There's now a real geographical kind of bias here. One of the kind of behavioral biases we have as investors, we tend to skew, and this is really, again, talking about North American investors, we tend to skew our investment decisions. We tend to invest in stocks and bonds that are more local, are more geographically closer to us than we do invest in more foreign, far off kind of places. We're biased towards that. We're more predisposed to do that. And so it's interesting to see that this robo portfolio, which again is being managed and being advised by, according to the website, a lot of really smart, highly academic people who are very well trained and very well grounded in a lot of investing principles and portfolio management principles, going literally all in on a couple of sectors. And so I found that really surprising. I didn't really think I didn't think it would go there like this. So that kind of jumped out at me. The second whole principle, and again, one of the value propositions of Robo Advisor services, is they tend to make investments using ETFs because they don't believe in picking stocks. They just, they're not in the business of picking stocks. They just don't have, they basically say it's picking stocks is useless. It's better to pick, have a broad exposure to different asset classes. So yeah, they may not be picking stocks, but they sure as heck looks like they're picking sectors, and it looks like they're picking geography, and they're picking regions as part of their as part of their investment strategy, and there seem to be very concentrated kind of allocations. And the reality is that's not really any different from me like building a portfolio of individual stocks. Like it's kind of almost, it's got shades of kind of like market timing type thing. So what are they doing? Like, are they trying to time the market somehow? Is this what's the logic here? So this really kind of puzzled me, because this is like literally the third biggest, in the 2.5 years I've had this portfolio, this is almost like the third now significant asset allocation adjustment to the weightings of my portfolio. And again, coming down to basic principles of what asset allocation, basic principles of investing, what all the academics and all the smart people keep telling us is that you just develop an asset allocation and stick to it and adjust, rebalance, and but stay core to your asset allocation. So if you're 20% into Canadian stocks and 10% into US stocks, that's your allocation. You stay around that. You don't just take it 20% and go to like 40%, or in my case, go from 15% US equities to 32.5%, just kind of flipping around type thing, because you're just in a way, you're kind of churning your portfolio. And I'll get to that in a second, because that's my second observation that's come out of this, out of what I'm seeing right now. It's just, that's the principle of asset allocation. As soon as one portfolio gets really high, one section of the portfolio gets really high, then you sell a portion of it to bring it back into balance and take the proceeds and reinvest it in the area that's underweighted. And that's kind of over time, if you do that kind of rebalancing, and that's something this My Robo portfolio promotes quite heavily. Over time, that's how you consistently and increase your chances of creating wealth or growing your savings at a meaningful rate. So it just seems like it's just right now, as of what I'm seeing right now, it's just not doing it. And it's going pretty heavy. It's making concentrated asset allocations changes, and it's literally almost kind of like it's picking kind of sectors. It's literally kind of stock picking, sector picking, region picking kind of ideology that's going on right now. So this really kind of scratched my head, and I've been trying to like wrap my head, trying to like, why is it doing this? So you know what I did? I ended up, what I doing is I called my Robo Advisor. I literally called them up, and I haven't really talked, which is interesting because in the 2.5 years I've been doing this, I've had this portfolio. I haven't talked after I set up the account. At that point, I have yet to speak to a human being about this portfolio. Nobody's really called me and reached out to me from the Robo Advisor service, or I haven't bothered going and reaching out and that's fine, because I guess you have to expect that. And that's kind of a takeaway you need to expect when you're dealing with a Robo Advisor service, is they're not going to be kind of it's kind of, you have to seek them out. They're not going to just go and say, hey, how's it going? Let's touch base on your portfolio. They'll send you the statements. You get access to the website. You have everything in front of you. So they're really great from that kind of transparency perspective. But they're not going to just call you up and just say, hey, let's get together for a coffee and talk about your portfolio and see how things are. So you need to understand that if you're the type of person who needs to have that kind of human interaction, you're not going to get it really ideally with a robo portfolio. So what I did was I tried to get I wanted to get some answers on this. I just wanted to hear. I didn't want to like critique them, because the whole point of this is just to see how this evolves, how the experience evolves, what their logic is in doing some of the things that they're doing, and how they present things to us as investors. So I just wanted to just ask the question and just literally shut up after that and just hear what they have to say. So I called my Robo Advisor up and I asked them I just wanted to get some clarification and just a better understanding of what the logic is in them changing the portfolio weightings and going heavily into US and Canadian equities. And so this is what the Robo Advisor came back with. And again, I'm paraphrasing a bit here, but I just want to get the concepts here. So I'm going to talk about the concept and just sort of give you my takes on what they said. So talk to the person, very nice person, very amicable, there to really they're trying to help out, getting the answers of what I need. But this is what they came up with. So first thing they said was, because after I filled out my profile and assessing my risk preference, my risk tolerance, that it came out that for me, my portfolio should be skewed towards an 85-15% equity bond ratio, and which is again, so that's what they said. Second thing they talked about was the decision to change the weightings in the portfolio is totally driven by algorithms. That's the other thing they said. The portfolio is constantly rebalancing. So when there are fluctuations and changes, they will rebalance, and they rebalance, quite consistently. That's what they said. The person also commented that I've done really well with my U.S. portion, and it's probably a big factor in what's driven the prices, and what's driven why I've been able to generate a high portfolio return so far this year. And finally, the person said that they tend to, I guess the algorithms and the people who are running this thing tend to skew their preference for investments towards Canadian and U.S. Oriented companies, and I guess ETFs, versus foreign assets. So that's what they said in terms of their explanation for it. So as I said, I didn't challenge anything. I didn't question anything. I just took it. So that was their feedback on it. So what do I think about it? Well, basically what they're telling me is that, you're 85-15, you're all in on stocks. So whether you're 30% in US, or 20% or 50% or 60% in US or Canadian or whatever, you have high weightings in terms of that's because your portfolio is skewed to a higher risk profile, you should be fine with it. So that's one thing that seems to be. It's like, well, this is what you are, so this shouldn't be anything surprising to you. What's clear also is now, because there's, you talked about algorithms really making decisions. Well, the algorithms have clearly have made a decision to go all in on the North American market. And from perspective, again, if you don't know anything about stocks or in investing, you think, okay, that's fine. The reality is we've been through an 8-year bull market in stocks, in North American stocks. The American stock, U.S. stock market has just been surging for the last 8 years, driven by so many different factors I've talked about. I don't want to get into it now. It's ripe for a serious pullback. And right now, with the portfolio skewed heavily for a third of the money, my money skewed towards U.S. stocks, that's kind of worrisome. So if the market craps out, this 5% return I've got so far and 14% return I've got since inception is probably going to take quite a hell of a hit because I'm so concentrated in those portfolios. The other thing I took away from it when he mentioned the whole well, you're in U.S. stocks, so you're making money. So to me, it was almost like, hey, what's the issue? You're making money. Everything's good. Everything's awesome. And I'm going, yeah, right now it is. But right now, we invest for the future. And right now, the way the portfolio is set up is if the market craps out, if the U.S. stock market craps out, if the S&P 500 and all that stuff goes down, NASDAQ goes down, there are going to be some problems with this portfolio. So that's one element that's jumping out at me based on his comments. And finally, the fact of the matter, it's gone all in on the North American market. It's, it's textbook geographical bias. They just don't want to look beyond the North American market. It's interesting because now 20%, 22% of my money now is invested in the Canadian market, which represents 6% of the world stock market. So almost like a fifth of my money is now invested in such a small area part of the world. I'm ignoring a hell of a lot of opportunities. Granted, now my U.S. component now is a third of my portfolio, and the U.S. market is a major market in the world, but it's not the only market. There's lots of things. We're living in a very globalized society and a globalized economy now. There's major investment opportunities beyond North America. Asia's developing. Europe is now showing a bit of a comeback. Africa, there's lots of opportunities out there. And one of the core elements of kind of overcoming geographical bias is having a broad exposure into other types of, in other parts of the world, getting outside our postal code. So it's interesting that my Robo portfolio has chosen to go all in on North America. And so let's see what happens, how that plays out. So that's my response to it. And, it kind of didn't give me a heck of a lot of a comfort level, as I said. Based on that, I didn't have a great comfort. It's like, okay, if that's what you think, that's okay. I'll go with it. That's the whole point of this exercise experiment I'm doing. Let's just wait and see how it pans out. So this is one element with the asset allocation. The second observation I want to share with you with my portfolio is inside that U.S. component of my portfolio. Up until now, it was represented by one ETF. It was basically the Vanguard Total Return ETF, which is the ticker symbol VTI. What it is it invests in literally every stock in America, every U.S. stock. So it's not just the S&P 500 or Dow Jones. It's literally all small cap, mid cap, any and every stock in the U.S., publicly traded company in the U.S. that this ETF invests in. So you literally get exposure to America. So that's been, and it's still the main component. It's still the component of the portfolio. But what has happened is my Robo has decided to add another ETF to cover the U.S. market, and this is ticker symbol VUS. It's this Vanguard. It's a Vanguard ETF. Again, that's investing in the U.S. stock market, U.S. stocks. And at first, I was like, well, okay, I thought it was an error. I thought it was a mistake. Remember earlier on in my previous podcast, I thought it was a mistake, but it's not a mistake. It's still there. I have two U.S. And here's the thing, the Vanguard, and this is the ticker symbol VUS, and this is the Canadian, actually, Vanguard ETF. And at first I thought, okay, maybe it's investing in a concentrated sector of the U.S. stock market or, type thing. But I looked at the ETF. It is investing. You know what it's investing in? It's investing in the other ETF, VTI. So it's buying shares of the VTI, which is the one I already have. And so what the hell? I'm holding the same. Why didn't it just buy more shares of the VTI? Why do we need to buy a totally different ETF? Here's the other kicker is the VTI, in terms of cost, the management expense ratio, MER of the VTI is 0.04%, 4 basis points. The MER of the VUS, this new ETF that my Robo has added, is 0.16. So it's 4 times more expensive than the VTI. So it's like, what what's up with this? So I did a little more digging, and I found it turns out that it invests exactly in the VTI ETF. But what it does is it also hedges the currency exposure, because the VTI is priced in US dollars, and so the VUS is priced in Canadian dollars. So there's, you're opening yourself up to some currency risk, even with the VTI. So what it's doing is it's trying to hedge away that risk and doing some things behind the scenes to preserve the value of that allocation. Should the US dollar depreciate in value, then ultimately the value of assets in Canadian dollars would depreciate too. And so what it's trying to do is hedge out that risk, and to do that. So, which is there's different schools of thought out there, whether it's even worth hedging currencies to protect portfolios. Some people say if you're investing for 20, 30 years, then it's pretty much a wash. It's not going to make it much of a difference. But if you're investing, short term, maybe it's good to have a portion of that exposure hedged away for currency risk. So again, I asked I was like, what is going on with this? So what's the logic behind this? And I'm thinking, okay, it seems like currency hedging is what it's about. So when I was talking to my Robo Advisor person, I asked them about, the logic of having two US ETFs now, one basically investing in the other. Like, what's the logic in that? And the response again I'm paraphrasing, is, the Robo Advisor, the Robo Advisor people, or the computer, I guess, they like to have options. And rather than having a single ETF represent a total sector, or weighting of that sector, they like to invest in multiple ETFs. And the logic being is it allows portfolio to get more exposure to that market or that sector, and allows you to get into more diverse investments. And the logic being is over the long term, that's going to be more healthy for your portfolio, and it's going to generate more returns for your portfolio. That's what they said. And I didn't question anything. I just listened. I took it. But then when I hung up the phone, I literally went, WTF. Like, what the hell? Like, what is this? Are you kidding me? I was like, it's not like this one ETF is investing in the S&P 500 and this other ETF is investing in the retail sector or the pharmacy subindex of the S&P 500. It's investing in the same thing. It's all investing in the same. There's no, you're not getting more diverse investment. You're investing in the same thing. And you're paying 4 times the price for it. So I'm trying to figure out the logic here so the end was like, you get more exposure and you get more diverse investments, which is healthy and better for your portfolio long term. I don't like it. Why don't you just buy more of the VTI? Or just, if you're so worried about currency exposure, sell the VTI and just buy the VUS. Get your exposure that way. Make that decision. But again, I don't know what they're trying. I don't understand the logic. And that's the thing. I'm I'm a little bit more versed in this stuff. But, average person who's out there just putting their money in this stuff would not know this or didn't even see this. So again, I'm really puzzled. And the part of the fact of the matter also is it's 4 times more expensive, and the fact that it's there's kind of a backdoor kind of churning effect going on here. It hasn't sold any of my U.S. position, but it's kind of, when you're adding new different products into the mix to get that exposure, you're kind of just churning return. You're churning exposure. So again, I really don't understand it. Again, let's see how it goes. Let's see how it plays out. But right now, it's a little bit puzzling. So, and the interesting thing about it is the person I was talking to didn't even mention anything about the currency hedging aspect of it. Didn't even bring it up. Like, I only bring it up because I went and looked at what this Vanguard ETF does and what their investment strategy is and their investment philosophy. And they talk specifically, it's currency hedged, and this is why they do it. The Robo Advisor person didn't even bring it up. I don't even know. Do they even know that this was the logic? It just seemed like the response was very kind of, again, very generic, very boilerplatey kind of standard scripty kind of response. We get more exposure, it's good for your returns, la da 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 da, life is good, life's a party kind of thing. So really, I don't know, interesting stuff that's coming up, that's popping up with this portfolio. Another interesting thing, just as an observation, is one of the big value propositions of this type of service is the technology component, where you have that access to your, real time, kind of almost real time access to your portfolio, your status of your portfolio, your performance of your portfolio, how it's doing, the asset allocation, all that stuff. The one thing it doesn't have is that kind of messaging, because I'll be honest, like, when you're changing your portfolio like what these guys have done, it'd be nice to kind of know about it. I only knew about it because I just happened to go in it one day, and otherwise I would have just, like, for most people, it's like out of sight, out of mind. They wouldn't even know about it until you get a statement. So if I didn't happen to go on to their app in February, I would have got the statement or checked in June or July here, and I would be like, what the hell? So you'd think with the amount of technology, emphasis on technology here, that they would kind of have some kind of messaging system or some kind of notification system to inform the customer, the investor, that, hey, you know what, we've made this kind of change to your portfolio. This is the weightings now. This is the logic behind it. Just FYI. Again, the tools are there. The technology is there to wire investors in, to get people more engaged in their investments. It's weird that they haven't gone there yet. Maybe they're not there. Maybe it's coming, but it's something that just jumped out, because this would be a great kind of way to get people more engaged and more up to speed with how their investments are doing. It's just having that messaging kind of thing, especially when there's really material changes going on in your portfolio. Wouldn't you want to know? You want to know about it. So that's kind of what I've seen. Those are some of the observations of what's come out of the portfolio. Again, I'm wondering, these are kind of major changes and major events, and I think, are we kind of starting to see a little bit of what the true colors of these portfolios, these type of portfolios, and how they're managed? Are we seeing kind of like, this is really kind of what's going down with it? Because it's interesting. And again, at the end of the day, the portfolio is making money right now. It's generating great returns. Decent returns, not outstanding, decent returns. So it's good from that perspective. It's just interesting to see if but we've been through such an incredible market in the last while. Eventually, at some point, it's going to tank. And it'll be interesting to see how these portfolios react and perform under that kind of stress, under a really sustained period of market stress. And so that's the thing we want to do with this whole experiment. We want to see how they do in good times, and we want to see how they do in bad times. So right now, the way the portfolio seems to be shifting really going highly concentrated in a bunch of asset classes, and really opening himself to a lot of risks should those asset classes kind of tank and not do well. So, as I said, we'll keep going, we'll keep listening, we'll keep following, I'll keep updating you. If stuff comes up with the portfolio, I'll be more than happy. I'm here to share it with you. What I hope for you can do from this is, again, just take this away. If you're somebody who's considering investing in with a Robo Advisor service, I hope you take some of these things, because chances are the type of insights you're going to get here, you're not going to get it from a Robo Advisor, and you're not going to get it probably from some other third-party kind of thing. Mainstream media, they're all pretty gaga about this approach, and the level of objectivity may not be the greatest. So that's what I love about what I do, is I'm sharing you like real-time, tangible insights into how these things work. Granted, it's one company. There's all kinds of companies out there, but these are things that what I'm sharing with you, I think you need to be aware of. And if you are with a Robo Advisor service, these are the type of things you need to just look for when you're seeing how your portfolios are doing. And then also ask questions. I'm all about asking questions, right? So ask questions. If something doesn't make sense in your portfolio, why is that, like, the weighting so out whack? Why are they changing all the time? Why are you buying this ETF, not this? Ask questions, get some more insight, be more educated about what your money is doing for you. That's the key takeaway, really what I want to get you from investing in this side of it. So that's all I got for you today. A really long episode too, but a ton of stuff I really wanted to share with you and get out there and help you digest it all. If you have any more questions about it, feel free to give me a shout through my website, sageinvestors.ca. You hit me through an email there. You can follow me on Twitter. My handle is @SageInvestors. I'm on there all the time commenting about things going on in the market. I'm also sharing my investment decisions in real time, just to give you some color and some of the thought processes that I'm doing and I'm facing and I'm thinking when I'm making investment decisions. If you're interested, also once a week, every Wednesday, I send out a newsletter. talking about just keeping people updated on my upcoming podcasts, recent podcasts, blog posts, stuff that's going on my website, and also sharing with you stuff that I'm reading on a day-to-day basis that I'm finding quite useful and helping me make my own investment decisions. I share a bunch of links and some little quick tidbits and insights on there. So if you're interested in getting that newsletter, you can just go to my website, sageinvestors.ca, and just drop your email in there. And every Wednesday morning in your email box, you'll have something there for you to check out to help you out, to give you some more insight and more perspectives as you frame your own investing decisions. So that's all I got for you this week. Thank you so much for listening. If you're on iTunes, feel free to subscribe to the podcast. Feel free to like and put stars, and I don't know what else you get to do to just kind of pass the buzz. Feel free to pass it on to your friends and family and all that kind of stuff. Thank you so much for listening. We'll be back again next week for another episode of Stock Talk. Again, my name is Amin Reina of Sage Investors. Thank you for listening, and we'll catch you again another time. Take care.